Conrad, welcome to Tito Spaces. Conrad is co-founder and chief product officer of Fintrax Network. So let's dive in. Can you describe your crypto journey?
Yeah, first of all, thanks, Ara, for hosting me and appreciate Blue Jay Finance for having me as well. I think if we go down to the crypto journey, I started around 2017, I think, when I learned about Bitcoin and Ethereum. And at the time, I was pursuing a medicine career. I was in medical school at Toronto. But I had this nagging feeling that blockchain really was very exciting and a technology that can enable so many possibilities for life improvements. And at the time, I found myself an opportunity to actually pursue a future in blockchain by co-founding my current company, Fintrux. I was my co-founder in 2017. So I did what any normal person would do and dropped out of school and started the company and was able to successfully raise funds for it in 2018 and have just been working on it ever since.
That's awesome. So, how would you describe Fintrax to those who are new to it?
Yeah, so I think our tagline or the way that we like to describe ourselves is that we're really just building smart business and financial solutions that are built on the blockchain. And ever since we started in 2017, we've been innovating over and over on real world solutions to help drive business growth and sustainability, and specifically targeting underserved startups and SMEs. So we really demonstrated this with our first product, which was Trucks, the Trucks platform, which was the world's first smart business financing platform. It really enabled businesses to structure their outstanding payables, which is basically when businesses owe each other money, into lines of credit, right? So turning that into something that was actually had a payment schedule and eventually it'll get paid off versus accounts payable can just sit there for years. And actually using smart contracts to govern the contracts between vendor and clients and helped hundreds of businesses really build up their credit. Then we enhanced our offerings with Trucks Flow, which then connected these borrowings to institutional lenders and brokers to provide more liquidity.
Thanks for sharing that, Conrad. So, can you tell us more about the types of loans that you give and the types of borrowers?
Yeah, so on the platform, we've been able to facilitate unsecured lending, lines of credit, even up to invoice financing. And the interesting thing is that we've seen startups with under 3 years of operations join the platform, as well as SMEs with well over 10 years of operations join as well. So I think the credit crunch and the lack of liquidity isn't something that's just felt by new businesses, but really by businesses of all different sizes. But specifically, we found ourselves to be most helpful for SMEs and startups.
That's fascinating that you can service those with under 3 years of operations and those with 10 plus years of experience operations. So, for those in the audience who are SMEs, what is the best deal that Fintrax has done so far?
I think the word deal is very interesting. I think if you're coming from the perspective of an SME, by the way, if you guys don't know what the terminology, SME is a small or medium enterprise. And ultimately, I think, any business, when you're going through and trying to build out your product and really build up a business, what you're looking to do is make sure you're sustainable, right? Make sure you can have a runway that lasts you a reasonable amount of time and continuously build more value so that other customers can hopefully fund your growth. So sometimes when you're in a situation where you need credit and the banks aren't willing to give it to you because you don't have enough credit score or you're not able to get more liquidity for the existing lines of credit, what can you do? We are very proud of being able to help a startup, one of our startups, to really get $1 million of unsecured financing, which means that it wasn't secured by anything, right? They didn't need to show collateral or they didn't need to put up equity for it, and really help them get that financing in order for them to sustain their business. And even especially during COVID times, we were successful in helping them get a pause on principal interest payments for a year, which we've been really proud of being able to help do because they've been able to then recover from their position, especially during the downtime of COVID, and then come out stronger than ever. and be able to repay their loans.
That's awesome that you were able to help these businesses out, especially during COVID times. And are these businesses in Singapore or like where's FinTrucks operating?
Yeah, so we like to say that we're a global platform. Really, we really don't block many people from joining the platform, obviously, aside from the sanctioned countries. But in regards to this startup, we're talking about Singapore was where they're from.
Oh, cool. So does the borrower have to put up collateral or does it depend on size?
Yeah, so it really depends on the situation. When we first started the business, we were heavily into unsecured loans because that's where we believed our product had a lot of potential and opportunity to make a difference. Because I think mostly in the lending market, when you go unsecured, the interest rates can skyrocket to 18%, 20%, even higher. And it's really unaffordable for a lot of businesses because how can you afford to pay 20% interest when ultimately you needed a loan to begin with? Unless you have a really good bet to bet on that you for sure are going to be able to recoup that 20% profit margin, basically, right from that investment. It's really difficult for them to cough that kind of percentage up. So when we first started, we are like, hey, our product is really good at creating transparency, creating trust, therefore lowering down the interest rate, as well as making it more efficient as well, which then lowers down the interest rate even more. That's where we first started our business and really tried to make an impact there. But over time, as we've seen, the lender risk appetite has really gone up a little bit more during the COVID times. This really has turned more into invoice financing now. So they don't have to put collateral, but they do have to put up the invoice that would essentially determine or dictate that they have future business coming in. And therefore, with that, we can offer them a lower interest rate through our lenders.
That's awesome. So what about the lenders? Do they need to be KYC'd?
Yeah, for the Trucks platform, it's all pure B2B. So all our lenders are businesses, whether they are within a supply chain or institutional lenders. So ultimately, they are KYC'd by nature.
Okay. What about when a borrower defaults? Like, where does the credit risk go?
Yeah, so I think this is the real interesting part and really speaks to our background as well. A little bit about us. The Fintrox team has been in the financing and banking space for, I think, over 30, 40 years, our individual talents. And the value of that is that because we've been in a space for so long and serving so many clients in especially the securitization space, we've picked up a lot of cool tricks from how big banks and big insurance companies really make their loan portfolios more safe. So the innovation of our product that we've brought from these bigger markets was that we offered quite a few ways to mitigate credit risk with over collateralization and also a reserve pool, and also a novel way of credit scoring based on payments made to vendors. But ultimately, really, I got to say that the risk does go to the lender as we simply provide the technology for the lender and the borrower to interact and then facilitate their loan on the blockchain. So hopefully that gives you some insights.
Well, that's great that you have all of this years of experience to build this awesome way of navigating this default process. And I understand in 2019 you had a $2 million fund where you worked with partners like F&F FinTech to initiate loans to small F&B businesses. And you were doing this whole real yield thing before it was popular. So we're wondering, how have times changed between now and then in 2019?
Yeah, first of all, real yield, I think that's something that everybody should be focusing on because that's really how you build a sustainable business. I think from the data we conceptualized FinTrucks, we had a strong focus on transparency because that's how trust is built. Personally, I think any platform offering yield that's coming from a black box is one really to be wary of because you have really no way of understanding how solvent the company can be. That's why really today we're doubling down on DeFi and are looking to launch the world's first regulated DeFi platform because we think that there's so much more that can be done in the space to really provide the retail market specifically and institutions, but everybody really a way to see where your funds are actually coming from, where your interest is coming from, so that there's an opportunity for everyone to benefit more so from what blockchain has to offer.
Awesome. So you've been in crypto since 2017 and FinTrux was started in 2017. What are the main lessons that you're taking away from operating FinTrux since then?
Yeah, I think we've seen a lot of platforms rise and fall. I really think the ones that have lasted are ones that are focused on building versus on marketing. Obviously, there should be a good balance on both because usually the ones that fixate on selling are the ones that end up not building that much value in the ecosystem overall. And I think that's why I'd even add on to my previous point too, is that there's a lot of platforms out there that are just pure black boxes. You have no idea how they're giving you yield, but oh look, 20% yield, here you go. And I don't need to name names. I think you guys already know who I'm referring to. And we just think there's a really opportune time for more transparent players to come in and really shape things up and focus more on building versus on selling.
Awesome. So speaking of building, congratulations on your upcoming launch of Staked.finance. What were your motivations behind this new product?
Yeah, so it's thank you for that, Hara. It's been really exciting working on Stake Finance. We've been really in stealth for the last year, and really the motivations that brought us here is that working in the B2B space has been really quite challenging, I think, even if you note the success that we have had, because there's been a lack of adoption by business owners because of their risk averse mindset. Obviously, that's improving over time. Crypto adoption is getting more and more. But we feel like while we're maturing that market, while we're slowly introducing more and more businesses into this idea of B2B financing with blockchain, we think that there's a product that needs to be built ASAP. And we haven't really seen anyone doing it. So we're forced to build it ourselves. Personally, we've been ETH holders since 2017, and for the longest time, we've lamented about the lack of options for ETH interest yield that is more than what, 2% back then when Compound was around, and then now at least more than 5%, even with staking platforms out there. But we also want that while managing the validity of ETH, because in a crypto winter, when everything crashes, you still want to know that you can buy bread, right? And you can still run a business if your company is in the crypto space. So I think that there's a lot of work to be done in this space. And we think that stake finance is a necessity, like a necessary product that had to come out. And since it wasn't out there, we might as well be the one to build it.
Oh, that's great. You built a product that you needed yourself. So, what is the best part of Staked Finance?
Yeah, like I think when we're thinking about investments, usually there's four things that you can rank an investment on when you're trying to recognize a whether or not a product is a good investment. So the first thing is capital gain, right? Does the overall value of the investment go up in price over time? Is it something of inherent utility or value that will be recognized by others when it's time for you to sell? The second thing is liquidity. Is your principal easily accessible to spend when it need be? As mentioned, we need money to thrive, right? You need to spend money on running a business, on buying bread, on having a house. Is it easy to take our money out without major penalties, right? And spend freely? The third thing is interest. What does it cost to maintain? Is there any risks involved? And do you have to spend money to keep the investment sound, or does the investment pay you interest? That's something that's very interesting to observe. And the fourth thing is stop loss. Is your principal protected? And what happens if the value drops drastically? Will your investment go down to zero? So our platform really offers all four in one offering, which is why I think it's really a special product out there and something that I personally haven't seen out there in the market. And I think if you ask me, it's the holy grail, I think, of investments.
Thanks for sharing the four things that investors usually look for, which is the capital gain, the liquidity, the interest, and the stop loss. So, our next question is, how does it really work?
Yeah, so first of all, we're fully decentralized and non-custodial. So our platform basically is just creating a decentralized way for users to stake ETH into a smart contract, which will then mint paid, which is an asset and algorithmically backed stablecoin. The staked ETH then goes into proof of stake validators on ETH to earn a real yield. then the paid, which you've then minted, can be used for real world transactions or then staked into the platform again to earn double-digit returns. And these rewards are made out of the staking and mining rewards from the ETH POS and the liquidations of the cash positions as the price of ETH fluctuates over time.
Thank you for explaining that in detail. So the next question would naturally be, how does it maintain PEG, and how do you give these interest-free loans?
Yeah, so as we mentioned that the stablecoin, which is paid, is both asset-backed and algorithmic-backed, which means that when the ETH price drops, we need to liquidate the ETH position, just like how MakerDAO does it, right? And then the paid is burnt. So when the ETH price goes up, users can just mint more paid because the value of their stake has risen. But ultimately, paid is always over-collateralized, which then gives us the opportunity to maintain PEG all the time because we know that there's always more value in the system than we're issuing in paid stablecoin.
Okay, so how would the stablecoin scale while maintaining stability?
Yeah, so the best way to think about our stablecoin is if you guys know the DeFi platform Liquidity, sorry, and seeing how they've been performing over the past year, they basically have a similar system where you stake ETH into their platform, and then they issue this stablecoin called LUSD. And you've seen over the past year that their stablecoin has been very stable over the past year. So and as you get more and more users, the stability of the stablecoin actually gets better and better because of the constant arbitrage happening on the platform. People going from ETH to then the stablecoin and stablecoin back, people creating positions on the platform, people joining the stability pools to then keep the token more stable. So what we've taken is we've actually taken Liquidity and combined it with Lido. You can think of it that way, right? Where you have real returns coming in from the Ethereum POS validators and also coming from the arbitrage that is happening on the platform where users might be liquidated depending on the risk that they take when they're minting their paid, right? They can mint more and be a bit less collateralized, or they can mint less, right, and be more collateralized. Given that there's an opportunity for players to come in and do this arbitrage together, we just think that as the stablecoin scales and as it gets into more exchanges, as people use it more, as more and more deposits come into the platform, it will just get more and more stable.
Thanks for sharing that, and for the liquidity Lido analogy. That really helps us understand it. So, who's gonna use stake finance?
Yeah, so we really want to build this platform for retail users who are trying to find a safe haven for their ETH. And we think it's really sad there actually aren't other options for users who still want to stay tethered in USD but have a stake in crypto. And we want to be there for people so that they know that if ETH appreciates, they have the upside of the ETH while it's appreciating, they're still earning more interest than they would be earning in their bank account. And at the same time, if it ever crashes, they can walk away with their USD value just like that. And at the same time, we know that this product is already a hit in the institutional market because a lot of institutions and family offices want to get into the crypto market. And at the same time, know that if a winter occurs, the value of their investments won't go down to zero and they can still save face and go back to their investors and let them know that they didn't lose everything.
Thank you for explaining who would use stake finance. And a question that came up is, what do you see as like the use cases of paid stablecoin?
Yeah, the use case of pay stablecoin is really like any other stablecoin on the base level. So I think of it as two levels, right? There's the layer one, layer two use cases. Layer one is our hope is that anybody who needs to use any kind of fiat-based spending token, right, inside the different ecosystems that are out there already in crypto can use paid as their way to spend. That should be the priority and number one use case for everybody to be able to scale to. But this layer two use case is very interesting for us because it's something that innately is generated from our platform. As we just mentioned, paid can be used like cash. That's the idea, right? They can get paid from the platform, use it however they want. But the greater utility is if they don't need to spend that paid immediately, they can then stake that back into the platform to earn the interest coming from the ETH staking in the validators, earning the 5%, 5.5% right now to be exact, plus the additional 10 to 15% that's coming from the arbitrage of the different cash positions, the basically ETH staking positions getting liquidated as the ETH price fluctuates. So really, realistically, anybody who's staking paid in a platform can earn 15 to 20% real yield. And mind you, this is truly real yield because you can see exactly where the yield is coming from, right? You know that it's because the Ethereum staking platform is working for Ethereum and helping, the longevity of the chain, as well as seeing that it's coming from real users being liquidated, and that's where your ETH gains are coming from, and not just a big black box like many other platforms have shown.
Thank you for breaking down the use cases for paid stablecoin. And we have two questions from the audience. One is, do you intend to join the products, for example, stake ETH, but actually lend to SMEs? And also, have you considered letting your client borrow capital from DeFi users who are looking for yield, especially if they want Singapore dollar exposure?
Ooh, okay, those are two big questions. Let's try to answer them one at a
Yeah,
time.
of course.
How can I see these questions, by the way, too? I'm curious, so I can actually read them and make sure I understand them correctly.
Okay, so I'm getting them in DMs, so I'm going to repeat the first question, which
Thank you.
was, do you intend to join the two products, for example, stake ETH, but actually lending to SMEs?
Oh, that's very interesting. At the moment, that's not the priority. And the reason behind that is because right now we don't see the platform as interchangeable. And let me explain why. The lending to the lending business is very variable, right? Depending on the credit rating of a business, you can make the decision to say, I want to lend to them or not based on this interest rate. But ultimately, you're pricing risk in because you don't know when the business might go out of business, right? Or they might not succeed in their uh, biggest bets, right? Why they're borrowing the money in the first place, or they might just out of any sunset. Maybe they're just sunset business. They just go out slowly, right? And that's something that the lenders price in when they're going through. And that's why we've always taken the position that, hey, if you're not ready to lend, if you're not an institution that's already in the lending space, or you're a business that already your client owes you money, you're forced to make a loan, right? If you're not those kind of businesses, probably you don't want to be a lender. That's not a space you want to be in. And that's why we think stake finance is so powerful, because we're creating yield out of something that already exists in the market without having to have the human element really of maintaining a successful business and making sure that yield doesn't just come from business success, but rather comes from an automated process that's always going to pay back. Ethereum isn't going to stop paying validator returns until Ethereum goes to zero. And again, if you believe in ETH like I do, we don't think that's going to happen in the near to far future. And also on top of that, the arbitrage on our own platform is algorithmically controlled. So again, unless ETH goes down to absolute zero, which then means that a lot of other businesses go out of business as well, like the risk of everything going to nothing is much less with stake finance than it is with the Trux platform with traditional lending. So therefore, we don't think the two businesses should connect, but rather we think that in terms of B2B liquidity, Trust platform will be there for everybody as long as they want it. And in terms of retail investors wanting to get a reasonable return from their ETH and stay pegged in USD, then that's going to be a product that they can go to for stake finance.
Thank you, Conrad, for breaking down why those two are not as easy to join as it seems. And the next question I got related to that was if you could share any regulatory challenges with lending in the SME space that you faced, if any.
Yeah, lending in the SME space is very difficult. I have to tell you that. Like when we first started in 2017, we came with the vision and the hope that anybody and everybody could be a lender, right, on our platform to then fuel the liquidity that we can provide to borrowers who might need those loans. And ultimately, while we were able to get the technology perfect, I'm so proud of our team because we really delivered on every function that we needed to build for this globalized peer B2B lending to take place. But when it came down to the regulations, you're not actually able to bring in retail investors unless you have licenses. And getting the licenses has been very difficult, at least on the lending side, because it's really a controlled market. I guess I gotta say it like that. And so that helped us make the decision to go pure B2B, because when you go business lending to businesses, there is much less regulatory oversight there because businesses know what they're doing. Again, the whole idea of regulatory processes is to help protect the consumer, help protect the retail. And in that case, when it comes to business lending, it is much more accepted, let's say, by the regulatory authorities. So therefore, we face a lot less challenges. But really, for the first 2 years of our business, we were just fighting against that. And it was very difficult doing the different pivots that we needed to do to focus on technology first to enable the kind of lending that we saw was going to be successful, and then finding a new class of lenders to then fill in the gaps of where we wanted the retail to fit in.
Thanks for sharing all the challenges and how you pivoted through them. Oh, if you're tuning in, remember to claim your Galaxy OATs. They're open now. And the other question that we got was if you would, in terms of SME lending, would you consider letting your clients borrow capital from DeFi users who are looking for yield, especially if they want SGD exposure?
Yeah. Again, I think that goes a bit into combining the two platforms. One thing that we are looking to do, just to open up the floor for that, but again, I think this will come in a year or two. This will probably be the next product after Stake Finance. But really, our focus is really on Stake Finance right now. It's a huge baby, and it's taking up a lot of our resources. But we think something very interesting is because we've already gotten all the loans that are transacted through the Trucks platform to essentially be on smart contracts, they can easily be tokenized and then sold to the retail investors as well as institutional. And that's something that our business we've always been in the business of even before FinTrucks. We currently have a product that we've been selling to the big banks and insurance companies for the last 20 years. And this is a securitization platform. And basically, it has around, I think, $3 billion assets under management, something like that, and over 90% market share. And the idea is simply that all these different loans that are accumulated on individual lenders' balance sheets can then be rolled up and wrapped up and sold to banks at scale and sold to additional lenders who are willing to take on the bulk loans as part of their investment portfolio and then buy them off the balance sheet of the individual lenders so that lenders have more capital to then lend out to more SMEs. And we always thought that was a beautiful model because that gave more capital to the system. And what we believe could be a real future is that all the loans that are accumulated on the Trucks platform can be tokenized and then sold individually to retail as well once we start building up the retail investor clientele on Stake Finance. So definitely that's something that we can grow into. But for now, pure decentralized financing is our play.
That's awesome. Thank you for answering our audience questions. So, as we're wrapping up, I wanted to know where you think the future of DeFi is going.
Yeah, definitely it's regulated. I think there's a lot of romanticism about pure anon projects and a radical shift away from the current financial system, which is, oh, so evil, right? But I think we've seen over the past years that the practices that the traditional financial markets utilize to protect retail investors are actually starting to be employed in the crypto markets to protect retail investors today. Like, I think a lot of people, as they're going through right now the bankruptcy of Celsius, the downfall of Luna, all these different platforms that have unfortunately gone bust, we see a lot of opportunity for regulatory oversight to come in to really protect the user so that retail doesn't end up getting screwed. Because I think a lot of DeFi has a lot of good to bring to the world, but in certain shapes and forms. And we believe that as a team, we believe that regulated DeFi is the future because there's no perfect system, but we don't need to be throwing away the baby with the bathwater. And the best future is one where we can combine both the elements of a decentralized future plus the regulatory oversight that will protect the customers at the end of the day.
Thank you for sharing that. We definitely see a more regulated DeFi future ahead. Remember to claim your OATs, everyone, from Galaxy. And that's the end of our spaces. Do you have any last thoughts? Or if anyone has questions, you can send them to us.
Yeah, something to close. Again, I appreciate Ara and the Blue Jay team for inviting me on. I think we're very excited. We've been really building in stealth for last year for Stake Finance. We've tried our best to create a product that we're super proud of that works for us first and foremost, because we love making sure that the things that we build are things that we need and we want to use. And we're launching next month. Stake Finance is launching next month. We have a waitlist ongoing. If you join the waitlist now, you'll have a discount on any of the fees that we're charging, plus just benefits everywhere. So just check that out. And I think that just stay tuned, follow us on our socials, and we'll be excited to continuously provide value to the DeFi and crypto world.
Awesome. Thanks for coming on to our spaces. It was awesome learning about, like, you've been building since 2017. Now you have this new product, and all the best for your launch in a month.
Thank you very much.
Thanks everyone for tuning in. Good night or good morning wherever you are. Bye bye.